We all live in a world of AI, apps, and video on demand. So wouldn't it be logical to invest in the future market, virtual healthcare? Even Cathie Wood said Teladoc is becoming the healthcare information backbone of the US, and she bought Teladoc Health for around $160-ish. But the market seems to refuse telehealthcare like Teladoc, and the price fell more than 95% from its all-time high. Welcome to this video, everyone. Today we will talk about Teladoc Health. I have read a lot of research, looked at the earnings, listened to the CEO's webcast, and all of that, so you can hear this in a compact form in this video. The business model. Their business model is providing telehealth and buying and integrating competitors into their ecosystem, like Medicine Direct, BetterHelp, InTouch Health for around $600 million US, Healthiest You, and Livongo in 22 was the last acquisition. All of them are in the space of telehealth, be it as telehealth providers for specific areas like chronic care, diabetes, or mental health, or as application manufacturers for the telehealth sector. When you have a smaller health issue like a sore throat or a cold or something, you could speak to a doctor on the phone or per video conference instead of actually going to the doctor. And because this doctor is registered in your area, in your US state, he can write you a prescription which allows you to pick up your medicine in your local pharmacy. Here we see they advertise their service with 24/7 access to doctors. So they do also offer direct-to-consumer service, which means the individual consumer, you and me, sign up for Teladoc services by themselves. But the much bigger segment is business to business. Healthcare is usually provided by employers, and that's why Teladoc targets large corporations. They pay a fixed monthly fee for their employees to access to the service. And this is much more efficient and cheaper than going to a doctor in person. And this way, the company can save a lot of money. The numbers they show look quite good, actually. For example, revenue just went up, also the adjusted EBITDA. So what we see here is earnings before interest, taxes, depreciation, and amortization. And this value is additionally adjusted. So let's take a closer look at that. We can see here, in order to reach this value, 89 million, they cut additionally a few costs, and the biggest part are stock-based compensations, which means managers and whatnot get paid directly in stocks. And by doing so, the company does not actually burn money, like they do not go deeper in debt, but instead they dilute the shareholder equity. For example, 2 years ago, there were 160 million shares in total. And now we have around 165 million shares in total. So every quarter, we as the owners, the shareholders, get inflated by around $50 million in order to support the company. You're welcome, Teladoc. If we look at the actual EBITDA, not the adjusted one, we see that the company is normally around zero somewhere. Just this quarter, Q3, they finished with a plus of 30 million. And net loss is normally around 60 million per quarter. So what are the insiders doing? Insiders are selling, but also they receive a lot of stock-based compensation. Now, behavior is always up for interpretation. For example, the CEO now still has 600,000 shares and kept his position rather stable over the last few years. But we also see that the CEO kept selling even as prices went as low as $30 or $22 per share. Bears say zero Moat. One of the biggest points of criticism has always been that Teladoc basically has zero moat. Even the CEO admits, quote, "On the consumer side, we don't really have a moat. The entry barriers are quite low." On the employer side, on the other side, they have the biggest and therefore most attractive solution for big companies, which normally want to save money, but they don't really want to cooperate with different regional service providers. Competitors can enter the market quite easily. We can, for example, see that Amazon has its own ambitions. Amazon first entered the market with Amazon Care, which was shut down later, but announced just last year to have another telehealth business, Amazon Clinic. And it was just rolled out in August 2023. Amazon Clinic, in my opinion, is very relevant to Teladoc. It's a US-wide video healthcare system, which means they don't offer their own telehealthcare, but connect customers to different regional providers under their name, making it much easier for smaller competitors to offer their service under the big brand Amazon. I generally like Teladoc's idea of being the biggest digital healthcare provider. But honestly, I like the idea of Amazon Clinic being the marketplace for digital healthcare, having actual providers under their big brand even more. It's not difficult to see potential in being the framework and one-stop shop for the actual healthcare providers, and therefore being a player in the telehealth field by delegating the actual work. But on the other hand, I also think that there is enough room for a few big players and a few big brands. Deficit and outstanding shares. Another major point bears bring up is the not so ideal financial situation. Yes, they have around 1 billion in cash, but we also have a company with debt 1.5 billion and an operating cash flow of around 100 million per quarter, which is around 400 million per year, already including the dilution stock-based compensation of around $50 million per quarter causes. So we do have a company with high operating expenses and a net loss. And to this, the market currently reacts allergically. In my opinion, that's not so bad for a growth company. Bears also do not like the slowing down growth, now only at around somewhere below 10% per year. Well, from my opinion, the growth came down, yes, but we should also not forget that there was a huge demand spike during COVID, and even though COVID is now over, the revenue still continued growing and growing. So for me, it's already a positive signal that there wasn't even a negative growth in revenue after COVID was over. Bulls say, market leader in a growing market. With all this negative sentiment, we cannot forget that Teladoc is still the market leader, and the market leaders normally have the biggest perspective to make profit in the long run. On the operative side, they are still going forward. For example, they made a collaboration with Northwell Health, that's a big hospital system in New York. And digital healthcare is a market with strong growth. Generally, it is expected to have an average growth of around 20% per year until 2030. This would indicate that there is enough room for several digital healthcare providers or systems. Cathie Wood. Cathie Wood is a very smart and experienced investor, and she believes in Teladoc. She bought T-Doc on average for around $160 per share, and she said it has the potential to 10x, and currently still holds around 4 million shares in total. Well, if she thinks $160 is a buy, what is then a price of $16? It's a buying opportunity. Just 2 years ago, having that was great as long as the company was growing. And then COVID was a great story for telehealth, firing up the price. Stock price peaked around $300 in 2021. With the current monetary policy and people got tired of COVID, the market became very critical towards unprofitable companies, and the story for telemedicine was over. This led to an overshoot in selling Teladoc, which might be right now a buying opportunity for just around $16. And by the way, when it comes to story, another lockdown could boost the price the same way as it did on the previous lockdown. And one more thought could be, when Teladoc as the largest provider is already struggling in being profitable, so will also all the small regional providers struggle even more. They cannot access money as easily as when the interest rates were low, leaving a chance for Teladoc to outlast their competitors. Thank you very much for watching this video. If you have any question, please leave a comment. Thank you. Bye-bye.